Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is November 4th, 2018 edition of Market Outlook. So the first thing is let's take a look at the key indices here. What is really obvious is that the Dow is clearly the strongest. It did two things this week with the rally. It regained its 200-day moving average and is now back into what I would consider a modest to strong warning phase because of this declining 50-day moving average. Now, the other things to note on the daily charts, if in fact there is a classic reversal, is for both the S&P to regain its 200-day moving average, which is just above the highs on Friday. So really a close above 276, 277 area would really confirm another breakout above the 200-day moving average and a phase reversal. Similar story, the highs on Friday in NASDAQ that failed basically on the Apple earnings report need to be taken out once again. So 172.75, 173 level is important. There is your overall setup in the indices and the key things to watch, keeping a totally flexible, open mind and basically reading the tape. Okay, the next thing to focus on is the fact that even with this nice bounce off of that recent sell-off and lows, look, we've got no major accumulation days with the exception of one, and that wasn't even all that convincing on the day that it happened. The market was just marginally up. So volume really not coming in. Love to see the market rally clear above those key moving averages in at least 3 out of the 4 indices. Right now, of course, we've got the Dow above that 200-day moving average. I'd love to see the S&P and the NASDAQ clear it. IWM is too far away to be in consideration. But if in fact we can get there, that would be a really positive sign, especially if we have some good volume. Okay, in terms of the, again, overall scenario, the thing that is also concerning is the fact that consumer staples, conservative play, right, is our best performer and actually positive. And it's the only one that's been positive, the only sector that's been positive over the last 3 months. Now, if you also take a look at it, the 3 months here, you've only got 2 sectors really that are up, and that is consumer staples and guess what? Utilities. So 2 conservative plays outperforming the market by a pretty good margin. Over the last 3 months, the S&P down almost 4%. And of course, the weakest here is home builders. If we recall, in 2006, 2007, there was this deterioration in home builders that was sort of leading or sort of a siren call that something was amiss. So we're going to keep an eye on that. Obviously, the pressure of interest rates definitely factoring in. So net, conservative plays still dominating. Now, the one good sign, and that maybe this market got oversold, has been that semiconductors had the strongest week. That's a spec sector. So if that can continue, that may mean that the conservative plays sort of got a bit overextended. So again, we're going to look back to the key indices as a where they are relative to the moving averages, that 200-day moving averages, and put it together with this sector rotation. So persistent strength in semis and consumer discretionary would be a good sign and a confirmation that those changes in the moving averages on the key indices are really well supported by the sector rotation. All right, that's it for now. Good luck with the trading, and see you next week.